Hi everyone. I'm not a big expert on M&A. I made only four acquisitions over my career, but I've learned something, so I'm here to share it with you. Before starting, otherwise people complain. Fast forward, I have created a business that went from zero to $200 million revenues. I with the team, we made an IPO at the Nasdaq, and after 19 years of career, I'm here to share what I have learned and the mistake I've done. Back to M&A. M&A means acquiring other companies. The reasons, as you know, I always push to have a strategic framework, asking yourself why we are doing something and what is the strategy behind. The strategic reasons behind the acquisition can be of four kind of acquisition, four kind of reasons. Reason number one can be consolidation. Consolidation means in a fragmented market, you buy competitors in order to have a bigger market share. For sure, when you do consolidation, also you do cost optimization because you get rid of redundant roles. You probably unify G&A cost structure, software. You do a lot of savings, but also you get rid of competition and you acquire customers and revenues. Making a acquisition on adjacent market means buying some product that are not in your market, that they are not directly competitor of you, but can give you the possibility to do a couple of things. Expand on adjacent market, so create a bigger total addressable market and use your customer as a potential buyer of the product you have acquired and the customers of the product you have acquired as customer base to sell your product. So you create two reciprocal captive markets. Geography expansion, you do M&A through acquisition of local players because you want to expand in a specific geography. Defensive can be I do investment, that means non-majority or non-total acquisition or total acquisition into uh, players that are not a threat now but can kill my market or kill myself in 5 years. So I'm putting one foot in the door in um, potential how can I say potential markets, potential opportunities, potential winners of the future. Usually, how we do M&A, how M&A is done. First of all, you define a strategy. It's an offensive M&A, that means that I'm aggressive and I want to position ahead of the competitors, or defensive. I mean, I need to consolidate because someone is margin are decreasing, someone is eating my market, blah 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 blah. And the how I want to do through revenue. I mean, consolidating revenues, expanding the market, moving to a geography, or arbitrage. What means arbitrage? That if I'm a public company traded at the Nasdaq or New York Stock Exchange, or where let's imagine a multiple on revenues or EBITDA, depends, are let's say 5 times, and you buy revenues into another geography, let's say, don't know, Germany, France, Turkey, wherever, where the revenues are traded at 2, you buy 10 million of revenues at 20 million devaluation to get 10 million of revenues more, valuated 50 million because the multiple on your market is pays the revenue 5. Approval. First of all, sending a non-binding LOI, which is a letter of intent. Usually, the letter. I mean, sometimes the letter of intent doesn't show the amount, the value of the transaction. They say only we are interested. Can you open a data room? That means the books and everything for running due diligence. Before sending the LOI, it's useful to discuss to the board to get the buy-in, which is very very important. But it's not. I mean, it's not an official act. It's just an exploration. So the board can be informed, but there is not yet an extraordinary operation. Then, when you have done this, usually you run the due diligence, and due diligence are done on books, papers, customers interview, source code analysis, people interview to see if the team is great, a great fit for organization and everything. If the due diligence is convincing and goes well, you do the acquisition. That means you go to the board approve the deal, you send the binding letter term sheet, of course negotiate red lines and conditions, and if accepted, the funds will be wired. And then you start the execution. You start engaging the SWAT team, which has been informed before, which is made by operation people, HR people, product people, and blah 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 blah, to start integrating the company. And then there is the integration that involves product integration, team integration, processes, accounting, operations, software, etc., etc. And it takes a while. Few useful concepts. Non-binding LOI, as we say, is a term sheet that says, that's okay, we are interested on you. We are interested to explore the possibility to buy your company. Can you open a data room? And usually you ask for exclusivity of 6 months. Say, we need 6 months to analyze the deal. Let's in this moment, in these months, you are not engaging any other M&A conversations. This can be accepted or not. Then the binding LOI is, okay, this is the offer, it's binding, cannot be revoked. This is the money we want to pay. This is the part of in cash, the part of our note, the part of equity, all the details that usually are heavily negotiated by the two lawyers, the lawyers of the buyer and the lawyers of the seller. And by the way, if you are keeping the founders with you, expect also to negotiate with the lawyers of the founders that will negotiate their compensation and package and so on and so on. So probably it's a three lawyer things, not two. Um, Sometime the payment is done through part in cash, part in equity. Earnout, it's if you reach some milestone, you unlock additional amount of money. So let's imagine that if a deal is $100 million, you get 30 million in cash, 30 million in equity, 40 million in earnout. Earnout is can be tied to economic results, to retention, to everything. If someone missed the earnout, that part will not be paid. And the milestones are related to the earnout. I mean, it can be if the product milestone are hit, you get this money. If sales get to this, you get this money, etc., etc. Last part is mistakes to avoid. As in M&A, you can do. I mean, first of all, M&A, it's a one-way door. You cannot, go back after you have done an M&A, say, "Oh, we're joking. Give me back the money. This is the company." No, you cannot do it. It's yours. It's a one-way door. So you need to have the buy-in of the board, of the executive, and usually of the company. Otherwise, you will face resistances internally on your organization, and the M&A can collapse. A lot of M&As goes very, very wrong. I mean, it's a super risky activity. It's something that I mean, it's carry a lot of risk. That said, uh, you usually, when you do M&A, you underestimate customer churn and employee migration. I mean, you cannot rely on the past 4 years customer churn, which are linear probably, but because I mean, an acquisition destabilize the customer. They are worried. They maybe don't like you. They think that they need to migrate to another product. So the churn probably will go very, very high. Same for the employees. You cannot rely on previous retention data. You have to factor in that some of the employees will leave. And that's why, error number three, not involving HR from day one, it's a mistake. You need not only assess the people, but also you need to think some retention compensation package for the people you consider key for the success of the M&A integration. And then these people usually are smaller than you in terms of size. So you have more processes in place, more compliance in place, and then they will go into a work environment which is more formal, more structured, and they don't have the freedom to do what they were used to do. And this is another factor to factor in when you buy a company. So, when you buy a company, usually the due diligence is mostly focused on financial, legal liabilities, those kind of things. But the source code analysis, it's equally important for two reasons. First of all, cybersecurity. Every cybersecurity liability, privacy data breach, hack, you name it, will it's your responsibility if you buy a company. It's not something that is something else problem, someone else problem. So the real problem here is if you are a company and you acquire a software that suffer a data breach because you haven't analyzed how secure is the code, what are the security policies, the cost related to lawsuit and everything will belong to you. And if you are a public company, the impact of the stock will impact the company, the value of your company. The second is the focus. The focus means that when you invest in a defensive approach into a company through a corporate arm, or you set up a corporate arm if you are not big enough, this is a big defocus. It's defocusing you from organic growth. It's defocusing you from innovation because you are, analyzing a deal flow and become a corporate venture or whatever. Also, all the M&A are at the focus. You have to factor in those elements. We are very close to the end of this training. The next chapters will touch topics like how to raise capital, how to make the perfect exit, creating wealth for yourself also and not only for investor, how an IPO works, etc., etc., etc.